Hey everybody, thanks for dialing in this evening. This is our Tuesday night training session. We do these every Tuesday night at 7 p.m. Eastern Time. Appreciate you coming in. Tonight we have a special guest, as you know, and what we're going to be discussing tonight is trading and your taxes. This is something that does not get talked about enough in the industry, but I will tell you that when you are a profitable trader, it becomes more and more serious that you need to understand the implications of taxes. And again, I don't know anything about it. I can't, nor do I want to know anything about it. But I can't suggest to you, I can't help you guys with taxes, none of that stuff. So I have done my due diligence. I've done my research. And tonight, we have a very special guest, as I mentioned. His name is Steve Ribble. He is the founder and CEO of Guardian Accounting Group, and as well as Trader Tax Coach. They are accounting firms catering to the trading community. He's a leading authority on trader taxation and trader entities, which is extremely important as well. Steve's a highly sought-after speaker, many public speaking engagements, works with traders from all over the United States, putting in place proactive strategies to minimize your taxes. He's been featured on U.S. News, World Report, Yahoo Business, Trader Planet, Trading Pub, and other publications and different media outlets out there. So if you would, put your hands together for Mr. Steve Ribble. Steve, you out there?
I am, sir. Yes, sir.
Okay. So if you want to grab the screen and get your PowerPoint up there and take over the mic, that would be awesome.
Okay. Let's see. What do I need to do to grab the screen, or is it already on mine?
So you should be able to grab it by there should be something on the right-hand side that says take over screen or change
presenter?
Yeah, go ahead and click that. Okay, there you go.
Show my screen. There we go.
There you are.
Now where'd my PowerPoint thing go? There we go. Is that good?
Right. That's cool, man. Take it up. Take it away, Steve.
All right. I know taxes. I don't know technology.
That's me. I know trading. I don't know technology either.
Exactly. It's a frustrating but a necessary evil. Well, good evening, everyone. I appreciate you spending your Valentine's evening with me. Hopefully, I don't want to make you guys fall in love with taxes, but hopefully make you aware of some of the things that you can do as a trader in securities. So we'll jump right in here. I don't want to keep you guys too late tonight. My agenda for tonight is, Steve kind of covered my introduction, so I think we can kind of gloss through that, but I'm going to spend time on basically three areas, looking at defining what a trader versus an investor is in the eyes of the IRS. I'm going to jump into a few court cases to kind of illustrate, exactly what the IRS looks for when they're trying to determine whether somebody should be taxed as an investor or taxed as a trader. And then we'll go into some of the benefits of being able to file as a trader, which is mainly going to be the deductions, some of the deductions that you are entitled to be able to take against your trading income. And then I'll open it up for some questions at the end. So we'll try to keep this relatively short. I think Steve said he wanted to go for maybe 20 or 25 minutes or something like that. So I'll try to hold to that agenda and time frame, and then take any questions that you guys have towards the end. The history of Guardian Accounting Group, just kind of a brief history. We've been working with traders since 2006. We've done thousands of trader tax returns over the years. We've got about 75 to 80% of our clients are traders located, all over the U.S. So I do get questions quite a bit. I'm down in Tampa, Florida, and I'll get people out in Seattle, Washington that are clients. But I do get questions on if somebody's in a different state, if they can still work with us, and absolutely. That's not an issue. We know how to get that handled and get that done. If you want more in-depth information, I've put up a lot of stuff on YouTube. So you can check out our YouTube videos that are up there, giving you more in-depth into some of the specifics about trader taxation and even how certain things are taxed in the financial world. As Steve said, I've been featured in Yahoo Finance, U.S. News World Report, Trader Planet, Trading Pub, and I've got a trading-specific tax site out there called TraderTaxCoach.net. That you can go on and get some more specific information about trader taxation as well if you want to see some stuff in print. So definitely use that as a resource. It's out there. So let's jump into trader or an investor. We get this question quite a bit. What does it take to be classified as a trader, and what does it mean? So that's really where we want to spend the next maybe 5 or 10 minutes, is kind of going through some of the specifics of that, and hopefully shedding a little bit more light on what it takes to be classified as a trader in the eyes of the IRS. Are you a trader? The problem I find with dealing with the IRS, and I don't know if anybody has any history of dealing with them, but if you try to read through their regulations and try to read through the code, you're going to find a lot of ambiguity. They don't really give a lot of clear definition one way or the other of what makes a trader or what makes an investor. Really, as a tax professional, where we've gathered our information and being able to help traders, down that path is going to come from the court cases, and that's why I wanted to spend a little bit of time on those to kind of illustrate exactly how the IRS arrives at some of the points that they arrive at. But the court cases really give us the clue, if you will, to be able to help somebody determine whether they're going to be taxed as a trader and whether they're going to be taxed as an investor. What the IRS says, and this kind of gets back into what I said previously, that they don't really give you a lot of specifics. My personal view is I think they do that and they keep it as a gray area so they have a means to go in and maybe audit people because they aren't very specific about what it takes and what it doesn't take. But that being said, I mean, this is right on IRS topic 429, traders and securities. This is verbatim of what the IRS says. You must seek the profit from daily market movements in the prices of securities and not from dividends, interest, and capital appreciation. Your activity must be substantial, and you must carry on the activity with continuity and regularity. And you can see there's zero specifics in what they talk about. So drilling down on this, I'm going to kind of drill down and drill down further on each one of these points to hopefully arrive at and give you guys the guidelines, as I call them. But we'll drill down on what the IRS says. The 4 things that they're going to look at specifically are going to be holding periods for securities bought and sold. They're going to look at the frequency and dollar amount of the trades that you've made during the year. They're going to look at the extent that you pursue the activity as you're basically running it as a business, as you're trying to make money to live on. And they also are going to look at the amount of time that you devote to the activity. So those are kind of the 4 keys, if you will, if you're taking any notes out there, but it's going to be the holding periods, the frequency, the extent that you run it as a business, and the amount of time that you're devoted to that business. I always tell traders to kind of look at it this way. If you were running any business out there, let's say a dry cleaners, you're going to run your trading business this exact same way. In other words, you wouldn't open the dry cleaners and open it for 2 months out of the year and then close it down. That's the same way with trading, and I'll show you some specifics here in a bit. But think of it like any other business, and that's the extent that you want to run your trading business like, and you should be okay when it comes to whether you're a trader or whether you're an investor. So let's dive in a little bit more. Yeah, and by the way, they will, if you miss any one of those 4, and we've seen it in the court cases where you might get 3 out of 4, what ends up happening is they'll neglect, they will mix your trader status, they'll make you get taxed as an investor, and what ends up happening is you lose home office deductions and other educational deductions that investors just aren't allowed to take. So there's a lot of penalties, as you'll see in some of the court cases, if you get this wrong. So let's jump into the court cases. Hopefully the sound is okay. I apologize. I don't know why if it's acting echoey or anything like that. I'm not sure what would be going on.
You're okay. We got a little bit of an echo, but you're okay.
Okay, cool. All right, so the first case we'll look at is Nelson versus the Commissioner. If you're keeping score out there, it's Tax Court Memo 2013-259. This is Sharon Nelson versus the Commissioner. Some of the background. Sharon Nelson had claimed trader status back in 05-06. However, the trades were executed by her, but also John Zabaski, who had authority to trade in her account. So she kind of outsourced some of the trading aspect of it, if you will. The IRS examined her trader status, and the tax court agreed with the IRS that she was to be taxed as an investor and not a trader. Some of the specifics. The 2005 stats, there were 250 trading days that year. She had 535 trades executed, and it was only on 121 days, so about 48% of the actual days she could have traded, they had trading activity. 95%, almost 18% of the total trades were done in one week period, so very concentrated, if you will. And her holding period was from 1 to 48 days. That's not bad from that standpoint, so I think she's okay there. And then 8 periods of at least a week that she had zero trading activity. And you remember back, one of the points was continuity and consistency in the trading that they look for. You can see that this was not the case, and that was the angle the IRS kind of took to negate her trader status. 2006, it was even worse. 250 trading days. She had 235 trades that year, less than one a day, and it was only on 66 days that she traded. So there was 26% of the actual trading days where their trades had occurred. Holding periods, you can see, lengthened. They went from to about 1 to 101 days on average from the holding periods. My gut tells me there was probably some positions that were down in value and we're just kind of holding longer term to try to see if they would come back. But I don't know that for sure, but that's just kind of my gut feeling on that. And she had 2 trades for pretty much the first part of the year. From January 27th to May 4th, only 2 trades executed. And again, 7 periods of at least 7 days with no trades. The issues, I think, with this one for 2006 are going to be the consistency. You can see it's very lacking in the trading patterns, and also the volume of trades was definitely lacking. So those are 2 issues that I think what ended up happening, and the tax court ruled in the IRS's favor and said that she was to be taxed as an investor, and she lost every deduction that she was trying to take from that. But this is the court's ruling. In determining whether a taxpayer's trading activity is substantial, we consider the number of trades executed in a year, the amount of money involved in those trades, and the number of days in which those trades were executed. So you remember when the IRS said that your trading must be substantial? This kind of gives you a little bit more of what they're looking at when they say substantial. The number of trades, the amount of money involved in those trades, the number of days that those trades are executed. Those are 3 key points, by the way. Okay, so kind of getting back to Sharon here, but Sharon lost her trader status, as I said. And here's some of the penalties that were involved. She was assessed a deficiency notice of $355,000 in taxes for 2005 with a penalty of $71,000 for understatement. And in 2006, it was a $307,000 tax penalty, $308,000 tax penalty that she had to make up, or deficiency, I should say, and the penalty was about $61,000, almost $62,000 that year. So substantial penalties in this case for getting it wrong and going down that road. So you can see the penalties can be pretty severe if you don't know what you're doing in this realm. Another case was Vanderlee versus the Commissioner, Hernicus Vanderlee versus the Commissioner, and this was tax case memo 2011-234. This is an individual who was actually a trader for several investment banks. He traded with Morgan Stanley, Goldman Sachs, and Merrill Lynch. He actually started trading his own account in 2002, and he claimed trader status for tax year 2002 and claimed mark-to-market losses of almost $1.4 million, and he claimed about $92,000 of business expenses that year as well. From experience here, I'll tell you that mark-to-market loss of 1.4 is probably what piqued the IRS's interest to look into this thing a lot further. I'm not going to get into mark-to-market. I think Steve had mentioned most of you trade futures, so it's not something a lot of future traders actually get into with mark-to-market. However, that being said, mark-to-market needs to be done in advance. Hernicus, Mr. Vanderlee, ended up going in his first year without making any advanced notification to the IRS that he was going to be a mark-to-market trader, and try to do it in hindsight, which you're going to lose every single time. So what ended up happening with the Vanderlee case? He got a deficiency notice of $620,000 and an additional $7,600 of accuracy-related penalties. This was due to that mark-to-market loss. A mark-to-market loss, you can actually claim the entire loss on your tax return, whereas we all know capital losses are restricted to being able to count against capital gains, but then only able to write off $3,000 against other income on the tax return. So that whole loss, that $1.4 million mark-to-market loss, gets recategorized as a capital loss, and he's only able to use $3,000 on his tax return. That's the reason for that deficiency notice of $620,000. He was trying to write it off against other income on his tax return. So that got reclassified, and the tax court, after reviewing the case, agreed with the IRS, and he lost this. And he lost because he had no mark-to-market election, as I talked about. And then they looked down into his trading, because he actually lost trader status. He only made 159 trades that year. So out of a 250 average trading days a year, he had less than one a day, and 41 of those were options trades. And his holding periods also worked against him. 35 of his 159 trades were from stocks that were bought prior to 2002, so counting in that long-term category. He had nothing bought and sold the same day, and the tax court really felt that he was looking more for appreciation than trying to take advantage of market swings. And the other thing counted against Vanderlee was his frequency was very sporadic. He only averaged 4 to 8 trades a month. And remember when I talked about like opening up a business like a dry cleaners, you're not going to open up the dry cleaners and be open 4 to 8 days for the month and then close down. And that's how you need to view your trading activity if you want to get classified as a trader, is that you need to be in there, if not every day, very, very frequently. And most of his trading activity did come in May, June, and December. My guess is December was tax loss selling from that standpoint, especially given the extent of the losses that he took. As I talked about, I kind of already went over this. The mark-to-market loss was recapitalized. He was only allowed to take $3,000. He disallowed all the expenses that he took, the $91,000 worth of expenses he was trying to claim on Schedule C. All of that got disallowed as well because investors can't deduct business expenses. So this was a very, very costly mistake. And I talked about the amount of money he owes in back taxes and accuracy-related penalties as a result. Now, given the amount of money involved, my gut tells me that Mr. Vanderlee probably had a professional, CPA or somebody else preparing his taxes, and this gets down into trader taxation as a specialized area, and whether it's me or another outfit out there, you definitely want to work with somebody that has experience in this area, because the cost of the mistakes, as you can see, can be very, very, very costly, very pricey, and the IRS loves to add on penalties and interest on top of the mistakes. So definitely work with somebody who has experience in this area and can help you navigate the ins and outs of it. So that was just a couple cases. Hopefully you're kind of getting an idea. I used to have a lot more that we went through, but again, time constraints, I want to kind of keep this concise for you guys. So let's look at some general guidelines for you. So what you should have is a substantial portion of your liquid net worth trading in the market. Notice I didn't say your entire net worth, but your liquid net worth. If you have an investment portfolio, having a good chunk of it in your trading account is kind of the start. You should have at least weekly buys and sell activity in your accounts. Daily obviously is even better, but I would say at least weekly activity that you've got trades in a consistent basis. Substantial number of buys and sells spread throughout the year. As you can see from some of the court cases, 1 to 500 even in some of those cases wasn't substantial enough in the court's eyes to tell, to rule that somebody was a trader. So you generally, if you're in that 1 to 200 range category, you're not going to hold up if you get audited and they look at your return closely. It's not going to hold up. You're going to be taxed as an investor every time. Generally, from the courts, 1,000 plus trades is in that safe category, and that's individual trades. So it could be 500 round trips. You're going to fall into that 1,000 plus trade category. That you'll be there and you'll be safe as far as when they look at substantial. Typical holding period should be under a month. Again, getting into weekly and daily being even better. You should spend a good portion of the time watching and trading the markets. I always encourage traders, especially new traders, as you're kind of launching out and learning this business, is to make sure you keep a time log. If you keep a trading journal of your day's activities and setups and things like that, and trades you took, trades you didn't take, then that's always very valuable information as far as learning the business. But it can also serve a purpose if you got audited and maybe you didn't run trades that day because they didn't set up for you, and there's nothing wrong with that. You don't want to obviously force things, but if you've got it documented that here's some trades that we were looking at that didn't set up, I mean that's going to go a long way in helping show the IRS that you're running it as a business. You're in fact running this thing in a business manner. And I talked about that. Keep good books and records. Keep the trading journal. Keep your trade logs. Review things on a consistent basis, and plan your attack on the markets. But all of that is going to serve you well if you happen to get an audit and you're able to kind of show them your trading journal and show them that you were in the markets. You didn't take a trade, but you were there and you were watching and you were looking for an opportunity. It just didn't present itself. And again, we're going to get back to the substantial portion. Some of the trading cases I didn't talk about, and you can see when I talked about 1,000 plus is going to be substantial, and pretty much stuff under that isn't going to be. There was an Endicott case where 2 of his years he had 204 and 303 trades. The court said that wasn't enough, but the year he had 1,543 trades, they said was substantial. A K case in 2011, 313 trades, not substantial. Holsinger in 2008, 372 trades, not substantial. The Mayer case in 1994, 1,136 trades, was substantial. So you can kind of see where we're getting at there when we talk about 1,000 plus. You're going to be fine. You can see it's really due to those court cases that we're getting that data. So the 3 keys to kind of take away, and really if you're trying to decide whether you qualify as a trader or not, the 3 keys that I can give you through all of that mud that we just kind of walked through: substantial number of trades, generally 1,000 plus, be consistent, no gaps in your trading activity. That doesn't mean, by the way, that you can't take a vacation, because again, think of the dry cleaner scenario. If you ran a dry cleaning business, it doesn't mean you can't take a vacation of a week or 2 and then get back at it when you get back, and that's the same way with your trading business. But they don't want to see gaps. They don't want to see most of your trades happening in the early part of the year, nothing over the entire summer, and then you're trading again in November and December. They want to see consistent trading throughout the year and consistent trading throughout the months. And you really shouldn't have an issue with this. Most traders wouldn't, but keep the majority of your trades short term. That does not mean you can't have long-term positions in your trading account, just as long as that's not the bulk of what you're turning over in that given year is long-term positions. There were court cases where that had been the issue. So it doesn't mean you can't take some long-term positions, long-term bets in the markets. You can certainly do that, but just, again, make sure that you do have a majority of your trading is that short-term in nature. So that kind of covers it, and the good news about this is, as far as electing trader status and whatnot, is that there's no formal election. I get asked that question quite a bit. What do I need to do to get classified as a trader? You do the activity, you're there. I mean, that's it. I mean, you'd be able to file as a trader in securities and take your business deductions with that. So because of that, because there's no formal election, what that means is that, and I apologize, these slides should have been updated for this year. But what that means is that you can claim trader status for 2016. So if you met the activity and you've never filed as a trader before, last year you met the activity requirements that we just kind of went through, you can file as a trader for 2016 and take your business deductions, any costs associated with your trading business. You can also go back for the prior 3 years if you, again, met the trading requirements and the activity levels, and you can amend those returns and claim your business expenses against that and potentially get some refund dollars back. So that's the good news about that, is that you can kind of go back in hindsight, as long as the activity was there, and claim trader status, file amended returns, and look for some refund money. So that kind of covers some of that stuff. If you're not sure if you qualify, I've got an evaluation tool on the Trader Tax Coach website. The URL is up there. You can go to tradertaxcoach.net/trader, and I believe that's an _status. You can actually fill that out, and then I can look over your activity levels and give you an honest opinion about whether you would qualify or maybe not qualify. If you fill that out, by the way, do me a favor and please put your email address in. You'd be surprised at how many people fill that out and leave the top part blank. And I have no idea who sent it in or how to even get back in touch with them. And they probably think I'm a jerk because I didn't respond back to them. But I've got no way of knowing who sent it in. So make sure you at least put your email address in so I have a way to contact you and review your status evaluation at a future date. So let's look at some of the benefits. You know, as we used to say in the sales world, what's in it for me? WWYFM, I have a favorite radio station. What's in it for you is tax breaks, and some of the things that you're able to write off that you would not be able to write off if you were classified as an investor. So you can write off chat room subscriptions. So if you belong to any chat rooms out there where you're communicating with other traders and sharing ideas and you pay a fee for that stuff, that's deductible. Data feeds such as DTI and IQ and market access, those things are deductible. Software subscriptions, Investor RT, Market Delta software for futures and things like that, those are going to be deductible. Newsletters, newspapers, Wall Street Journal, Investment Business Daily, any kind of trading education. I know some that will pay for training and learn how to trade. Some of it can be pretty substantial, but that stuff is deductible if you qualify as a trader in securities. Trading books and other publications, your telephone and cell line, we can deduct, because you execute trades through your cell phones, checking the markets, things like that. So we're able to kind of get the cell phone expenses in there. Internet, obviously, cable, TV, running, CNBC and some other stuff on TV. You're able to kind of expense part of the cable. Seminars. So if you go to any seminars or trading expos, your transportation to and from, lodging costs, meals, things like that, we can deduct to the trading business. As you get profitable, there's a lot more that you can get kind of creative on, if you will, and using the existing tax code as it is, and you can look for some additional deductions like wages paid to family members. I use that for traders who are profitable. And an example would be, if your kid's like mine, I've got a kid that does competitive soccer, and that gets pretty expensive, all the travels and stuff like that. So he works in the business. I pay him wages. He pays his own competitive soccer. So it's, in essence, I'm getting a tax deduction to pay for his soccer, but he's paying for it, obviously, and working for it. But it's the kind of the roundabout way to get some tax deductions, and something I was having to come out of pocket for anyway, and able to get some deductions against that. So there's creative ways as you get profitable in your trading business that you're able to kind of do some things structurally and take advantage of the tax codes. If you rent office space in your trading business, that's going to be deductible. Home office deductions, which obviously you can't take as an investor. Tablets and computers and computer-related supplies and office supplies, those are deductible. Depreciation and fixed assets, we can expense those. Margin interest, if you trade on margin, as a trader, it's fully deductible. As an investor, it's potentially deductible, but it's restricted. It's on Schedule A. So it has a lot more restrictions to being able to deduct it. Any legal fees tied to the trading business are deductible. Medical expense reimbursement plans, again, profitable traders. Retirement plans, I don't think I put that on there, but that's another strategy for profitable traders, and that we're able to drive down taxable income. And then tax preparation and tax advice. There's some stuff that is tax deductible as well. So hopefully that kind of gives you an idea of what it takes to be classified as a trader in securities and what it would mean to you on your tax return. So if most individuals I know that trade actually spend a substantial amount of money on trading itself, whether it's the software, the internets, and things like that. But it just depends on what you're spending. Is going to depend on what kind of a benefit you're going to get, obviously, for your trading business. So So kind of the next steps, I would tell you if you're not sure if you qualified or not, fill out the trader evaluation that I talked about on tradertaxcoach.net. It's not too late to claim trader status for 2016. If you've met the activity requirements, we can help you with that. You can also go back and review the prior 3 years and see if that's something that maybe you did qualify and you want to amend. Our firm can help you with that. Market elections on that, but you guys, if you're futures traders, it's probably not something that's going to come up. But if you've got questions on that at all, if you happen to trade other securities and things like that, you've got questions, I'm certainly happy to spend some time and go through that with you one-on-one. And you can reach me at my email address there, steve@guardianaccountinggroup.com. If you've got more specific questions or want to talk a little bit more specifically about your situation, I'm happy to take that. And with that, I think that's it. We also offer free consultations, guys. So I don't. I'm a flat fee guy, and so I charge a flat fee to do the tax work, and that includes questions and stuff like that. So I don't bill for questions. I kind of believe that should be part of the service I provide. If there's work to be done, that's a different story. And tax planning is a different story. But if you've got general questions on, trader taxation and whether something's deductible or how to structure this, things like that, I have what I call an open door policy. So my door is always open to call or email me, and I'm happy to spend some time and get you the right information. I would rather do it right up front as opposed to having a mess to clean up down the road if something else had kind of gone wrong there. And then before we jump into questions, I always love this quote. This is actually from a U.S. District Court judge, Judge Han. And he says, in America, there are two tax systems, one for the informed and one for the uninformed, and both systems are legal. And he is absolutely right on that. If you're, and hopefully today you got a little bit more informed about what you can do if you qualify as a trader in securities, guys. I'm not sure how I do this, but how do I get those questions out so I can kind of go through them, Steve? Do you know?
I will ask you the questions and you can answer them.
Perfect. Yeah, let's do that.
So the first question is, if you buy, say, 5 contracts in one trade, is that one trade or is that 5 trades?
It's a good question. That's one trade.
One trade, okay. So,
yeah, so it would be the same as if you bought 1,000 shares of stock. That's not 1,000 trades. It's going to be one trade. So one executable trade. So if you bought 5 contracts in one trade, the beautiful thing about margin, though, is you would never have to worry about the substantial dollar value because of the margin on future contracts. You end up trading a very large volume of it. Here's the other thing about futures trades that you want to keep in mind too. Is the activity on futures doesn't get looked at nearly as much because all you see and all gets reported is the bottom P&L. So if you've ever seen your 1099s from your brokers on your future contracts, it gives you your overall P&L for the year, and that's it. It doesn't detail out the amount of trading activity that took place. So you're kind of insulated in a degree if you're trading futures. I don't think you're going to be too concerned about the activity level. Just make sure it's consistent if they happen to look at it. But the volume, the dollar volume on future contracts is enormous. So for what it's worth, I wouldn't be too concerned if it's a futures, if you're a futures trader, because the activity itself, if you've ever compared the 1099s, the stock activity from those 1099s, they detail out every single stock trade. It's not that way with futures. It just gives you the overall P&L, and that's all the IRS ever sees either.
Cool. Does an individual or should an individual get set up as a LLC or like an S Corp or something?
That's a great question, Steve, and there's certainly outfits out there that will tell you and try to sell you an LLC at every turn. I'm not that way. I would tell you it depends on the trader and their situation. You're really not going to get many more deductions as a sole proprietor. And a sole proprietor, if you're not familiar with that, it's basically an unincorporated business. If you guys met the trading requirements for 2016, you're technically a sole proprietor. That would be how you would be classified to the IRS as a sole proprietor trader. So when I say that, it's just an unincorporated business. So as far as setting up an S Corp or setting up an LLC to trade through, you're not going to really get more deductions from that standpoint. Where it would make sense is if you're profitable. If you're a profitable trader, there's certainly things you could do inside of an entity like an LLC or an S Corp to help reduce taxation than you could if you were just a sole proprietor. So that's my kind of 2 cents on it. I kind of feel that it really is dependent upon where the trader is in their trading career. If they're consistently profitable, it's a conversation to have. If they're not, then I would kind of forego the expense. That being said, there's 2 instances where maybe it makes sense, is if you're borderline on the activity and you're not sure if you're going to qualify as an individual for trading, or maybe you work a full-time job and you're kind of nervous about trading on the side and whether it would be looked at in a different manner. Setting up an entity may make sense in that instance because the audit rates on entities are a heck of a lot less historically. Your audit rate for Schedule C businesses is historically about 8 to 10%. I mean, that means 8 to 10 out of 100 get audited. Whereas an S Corp or an LLC that files a separate tax return, the audit rates are under 0.5%. So 1 out of every 200 get audited. So if that's a concern, if you want to kind of give you a little bit more audit protection, then go the LLC S Corp route, or maybe you're working full time and you're kind of doing this on the side, you want to kind of push it a little bit more further under the radar, then maybe it makes sense to set that up. But otherwise, I say don't take on that extra expense unless it's really going to make sense for you. So hopefully that kind of gives you some clarity on my thoughts on that matter.
Cool. Tom and a couple others might be asking about links. Guys, just email me for the links that you want and I'll shoot them over to you guys. Marvin, you would need to talk to Steve directly about any fees and stuff like that. So contact Steve directly. Here's a question. If we have taken trader status and get declined, how many years can or will they go back and check because of that?
It's generally going to be the year in question. So if they, you saw some of the years that were audited in some of the court cases that I showed you. Those were the specific years that they audited. I mean, so I think the first one was like 2005, 2006. They audited both years. The IRS went and looked at both years. What triggered those audits in some of the cases? Now, remember, the IRS does not see the amount of trading activity firsthand. They don't look at that really specifically. What, in my opinion, triggered most of the audits that you see is an exorbitant amount of expenses, and somebody like Vanderlee, who tried to claim a huge mark-to-market loss and had never filed for mark-to-market election. I mean, those are the types of things that are going to trigger the IRS to look more closely at something. So if you're an average trader out there, by average I mean most of the ones that I've ever seen, you're not dealing with those types of expenses. Nobody tries to claim $90-some thousand of expenses in a trading business because
right.
I don't know many that would spend that type of money. But if you're in that 5 to 10, 15, even $20,000 expense range, and you've got your decent activity, I don't think you have anything to worry about. But as far as how far they would go back, they're going to look at that year and kind of that year only. It's kind of in a capsule, if you will. It doesn't open up a Pandora's box if they're going to start all of a sudden looking at everything.
All right. Let's say you qualified as a trader and you lost for the year. Can you still write off stuff? Let's say you bought a computer that year for tax for trading. Can you write that off and actually take a loss for the year with more deductions?
Yeah. So if you've got two scenarios here. Either you have other income on your tax return, maybe a W-2 job or a spouse that worked a W-2 job and you were trading full time, or you just traded full time and you had no other income on your tax return. So kind of the two different scenarios. But yeah, you can still take your trading expenses because they're valid and they're valid in the business. What's going to end up happening is that you're going to have a net operating loss for your business. It's called an NOL, or NOL for short. That net operating loss, one or two things can happen. If you've got other income on your tax return, it's going to offset that income dollar for dollar. So if you spent $10,000 in your trading business and you had a W-2 for 50,000, or you had a spouse who maybe made 50,000, then that 10,000 is going to count against that 50,000, and your taxable income is going to drop by 10 grand. It's going to be deducted against that. If there's no other income on your tax return, it's going to generate that net operating loss overall in your tax return, which you do one of two things. You can carry that operating loss back 2 years and amend a prior year, 2 years ago tax return against any income on that return, or you carry it forward and it counts against any other income in a future year. So it's very different than a capital loss, where you can only carry the capital loss forward, and the capital loss only counts against capital gains. The operating loss from your trading business is actually much more valuable, but it can be used against W-2 income and other income sources.
Okay.
That being said, please don't mistake the loss in your trading business, because if you're not mark to market, that still stays a capital loss. So if you lose $10,000 trading futures for the year and you spent $10,000 on trading equipment, the $10,000 in trading equipment and other expenses is what can be carried forward and carried back or used against other income. The $10,000 loss in your futures is a capital loss, and that's going to be restricted to the capital loss rule. So you got two sets of buckets here, so please don't confuse the two. But as far as the operating expenses, absolutely, you can still take those.
Cool. Does mark to market apply to stock options?
It does, yeah. I didn't get into mark to market, but yeah, mark to market would apply to stock options. So if you trade stock options, you can elect mark to market there. That takes it from an a capital gain, capital loss to ordinary income, ordinary gain, ordinary loss. And if you lose money on that, that would be very similar to the NOL that I just described. It's going to count as an NOL and be used against other tax returns. So yeah, if you trade other than futures, if you want to kind of get more information on mark to market, you feel free to set up a conference call with me if you want, and we can set up a call and be happy to walk you through it. I just didn't want to take too much time tonight, as I knew most of you traded futures, but yeah, you can.
That's cool. Do you have any associations with any kind of similar trading tax sources in Canada?
I don't, unfortunately. I get asked that question. I've gotten asked if I do tax returns up in Canada or England, around the world. Right. I don't. If it's an expat U.S. citizen living somewhere else, I can do it. But yeah, unfortunately, I don't have any resources up there. I'm just not familiar with their tax laws up there. I don't know what Sure. I don't even capital gains, capital losses, or I don't even know what that stuff. What they have it up there.
Right. So Willie says, if I own a business that's a corporation, will this interfere with any of the corporation's deductions?
That's a good question, and I would tell you, as long as there's separate deductions, you can't deduct the 100% of the internet expense in your corporation and then turn around and try to deduct 100% of your expense in the business. You're double dipping there. So if they're separate expenses, it's not gonna affect either one. If you are using joint expenses there, in other words, I'm using the internet in both businesses. I kind of use that as an example. I would just take it to one business, or maybe split it in two. But you may need, it just depends on where you need the deduction the most. But you can't use 100% of it in both places. And hopefully that answers your question.
Sure. Let's play make-believe for a second, and it's determined that I need, or I should set myself up as an LLC or a corporation. Doesn't matter.
Okay.
And is there a certain time of the year that it gets to be too late to actually start one?
I would tell you, here's what I would tell you. It kind of depends, and I don't mean to be vague, but I would look at the state laws, because some states make you file an annual report every year, and so if you're looking in November, December, and it's not a necessity that you have to have it right away, but if you file it in November, you might have to turn around after paying the incorporation fees, turn around in a month and a half and pay another fee at the start of the year as an annual report fee for the state. And so I would have to look into that aspect of it, and it depends on kind of how late in the year. But then it also depends on, do you need it? I mean, is it something that we're setting it up for a specific reason, such as funding a retirement plan or something like that? So, I hate to be vague on that answer, but it would really depend on the circumstances of what we're looking at before I could give a real honest answer on that.
Well, that's cool.
So hopefully that kind of makes sense.
Okay, very cool. Well, that's pretty much the end of the questions, and we're right on time here, 45 minutes in. Anybody who wants to contact Steve directly, Steve, if you want to put that slide back up of your email address.
Yeah, oops. I'll throw that up real quick. It's the last slide, I think. Yeah, just one. There you go.
Okay.
There's all my contact information. That's my office phone, my email, how you can get a hold of me.
Okay, so Steve's on Eastern Time. He's in Florida. There's his phone number. There's his email address. If you have questions, if you want to talk to him further about having him do your taxes, I know for one that I'm going to do that. There's his information. If you don't have a pen or you miss it, just contact me and I will get you the information. Steve, I want to really thank you for enlightening us on some of this, because I didn't know any of that stuff, and it's important for us to be educated in things like that, because I'm sure a lot of people make the mistake and think that they're classified as traders, and it looks like to be classified as a trader, you've got to be active, and it's got to be something you do, full time. Well, I mean, not full time, but every day or 4 days out of the week or something. So, and other than that, you're an investor. So this was great information today. I'm going to definitely have you back on, probably maybe once every 2 months or something like that, just to stay in touch with our people. So on behalf of
I can take questions. If you've got questions they want me to discuss, we can kind of put stuff around that, or we can come back and talk trading entities. There's a lot of different things we can kind of put some variety in there.
Right, and everybody's saying thank you. So with that being said, Steve, thank you very much from the members of Your Trading Day, and I will definitely be in touch with you soon.
Thank you so much. Have a good evening, everyone.
Okay, thank you. Hey, everybody, we're out of here. I will see you guys bright and early in the morning. I'll open the doors at 7:45 Eastern Time. 8 o'clock, we'll start trading. So get some sleep, get some rest. Say goodnight to your family, because we're going to rock and roll tomorrow morning. Thanks a lot, everybody. Have a sensational evening.